Hi, everyone. This is Jason Bierko of Wall Street for Main Street.
And Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 11. Now, Lee, there is lots to talk about. A lot of it is involving central banks, the European Union, the United Kingdom. The last show we did, I think, was 3-4 weeks ago. We didn't touch on the UK bailouts. From what we're hearing, from what we're gathering, they were at least $600 billion, according to a Fed insider, a DC insider that I spoke to. He tweeted it out. I spoke to him more about it. And it sounds like these bailouts, these currency swap lines, is just going to get worse going forward.
Well, the world has certainly gotten even more interesting since the last time we spoke, and there's just all kinds of craziness that's been happening in the UK. So why don't you talk a little bit about the swap lines, and then I'd like to talk a little bit about what's been going on with the pension funds there.
Well, we're recording this show on Tuesday night, October 18th, 2022. For our listeners out there, the dollar index is, I think, around 112. Gold's around 1,646. The silver price is lower. Commodities have taken a beating except for energy markets lately, although I think we might be nearing a bottom in the next 3 to 6 months if the Fed does stop rate hikes and QT. There's sources from DC, some of the same sources that were talking about the 600 billion bailouts that the UK government got, the currency swap lines, that the loans will be waived. So we'll see about that. But back to the UK bailouts, though. I mean, we had margin calls. The problem started, I think, 3 weeks ago, where the currency, the British pound against the dollar, was falling rapidly. The bond yields, I think, on the 30-year British government bond, I think it's called a gilt, they were rapidly spiking. And overnight, this was before the markets officially opened on Monday, you were starting to hear problems from the banks that were the counterparties that had these loans outstanding to pension funds, these UK pension funds, and they were getting absolutely enormous margin calls.
Well, basically what happens is most of the pension funds in the UK, they're different than, I don't know how many people in the United States have a defined benefit pension anymore. Most are on defined contribution, which is like a 401k plan, where your company actually puts money into a thing and you have your own investments. Whereas a defined benefit plan, you get a defined pension every year, depending on what the company rules are. You know, for the rest of your life, you'll get whatever X percentage of your salary had been. So in order to make those contributions to you or the retirement payouts, there are funds that are managed professionally by a fund manager. And part of their investment strategy it's called liability-driven investment. And basically what they're doing is they're trying to match up the payouts in the fund to what they need to pay out to their pensioners. And because interest rates have been going down for so long, they started using leverage in their gilt part of their asset management. And that just increased the risk so exponentially. And what happened is when the yields went up, the actual value in that gilt holding that they have went down because the price of bonds went down, and that forced the margin call. But the flip side of this, Jason, is the yields are going up, which is actually very beneficial to the pensions because it makes them easier to meet their liabilities going forward with the higher interest rates, and they'll have to take less risk doing it. So it's a very interesting situation.
But the pension funds are selling their assets now for cash to meet the margin calls, so they don't have the cash to go and buy those new bonds. So this is part of the problem. They didn't keep a lot of cash on the sidelines. They were investing it into these leverage trades. Now, the trades you talked about, they sound very similar, if not an exact copy of what Ray Dalio came up with decades ago at Bridgewater, risk parity, because bonds are normally boring. Ray Dalio came up with the risk parity strategy for a diversified stock and bond portfolio to juice the returns on the bond side using leverage. And in a zero interest rate policy environment where interest rates are falling, what a lot of hedge funds, family offices, and pension funds did, and the pension funds were probably suckered into this by flashy salespeople at investment banks or flashy salespeople at hedge funds or family offices that were trying to get the pension funds to invest in these, is they were saying, well, if we juice up the returns, the upside is enormous because you're not earning an easy 5 or 6% yield on your government bonds that were available in the past that you could compound. So while if you were leveraged on your risk parity while interest rates are falling, you wouldn't make necessarily the easy interest rate returns of 5 or 6% that you could compound over time, like you would with a dividend stock or a bond over time. But you would get capital gains then for the value of the bond increasing, especially with the leverage. But Lee, that's only talking about the upside. So when you look at an investment, unfortunately, a lot of these players here, they only look at the upside, the reward. They're not looking at the downside, the risk. So you have to balance what you're supposed to do. If you're a competent investment manager or competent risk manager, you're supposed to try to balance risk and reward. It sounds to me like a lot of these types of bond investments, especially with leverage, were only looking at the reward. They were not balancing the risk. And that's why we had blowups every time the Fed or other central banks, especially during the 2019 repo madness, where they were doing quantitative tightening and rate hike cycle. And now we go back into the same problems where rate hiking cycle blows up these leverage bond trades again.
Well, these pension funds are just humongous. I mean, they hold so much in assets. And I mean, we have quite a few here in the States, too. I mean, one of the largest is CalPERS in California. And these funds invest in all kinds of assets from, bonds to stocks, private equity firms. And all those things are leveraged. I mean, what's more leveraged than a private equity firm? They live and die by the LBO. So the leverage out there is just pretty insane when you really put it all together. And the risk, it hasn't been thought of in decades because they haven't needed to.
Well, I spoke with a hedge fund manager last week for an hour on the phone, and she was going through real-time derivatives reports and credit reports, more expensive than anything on a Bloomberg terminal. And basically all the major pension funds in the United States and Europe were getting enormous margin calls last week.
I'm sure.
It was a bloodbath.
Yeah. Well, what happens, I mean, it's kind of like a downward spiral because as they sell off their assets, the value of the assets go down, so their margin calls increase. So it's hard to stop that downward spiral at points. And especially a pension fund where you have your capital, it's tied up in investments. It's not easy to liquidate those and meet margin calls all the time because they're not sitting with a big pool of cash to cover things.
You also have a lot of larger entities that need to sell US Treasuries to raise cash. So in the past, the largest buyers of US Treasuries were the countries that were running enormous trade surpluses, as we've talked about on past shows, as I talked about recently in my interview with Lynn Alden, where we discussed problems with the global economy and how things are not working like they normally work in the past. You don't have Germany, China, Japan running large trade surpluses and then going and recycling those trade surpluses into buying more US Treasuries. So you have a lot of the entities, whether those are pension funds, whether those are central banks that are large net holders of US Treasuries like China and Japan, they want to sell their US Treasuries. Japan has had to sell US Treasuries for cash to go and defend their currency and their exchange rate. I believe 20 billion per day at one point they were doing in the last week to 10 days. They were doing foreign exchange intervention to try to defend their currency from further devaluations.
The world of currencies right now is probably the most volatile I remember. I mean, it's just so much going on right now.
Well, this is what happens, Lee, in an environment where the global economy is dealing with all these different problems, cross currents. You have large inflation in emerging markets. It's all over the world, really. Large inflation, but in emerging markets, they're dealing with so many different cross currents. We discussed a lot of these during the Lynn Alden interview last week, like I said. But right now, the strong dollar is causing a lot of problems for so many different entities, and you have higher interest rates, currency devaluations against the dollar, which is causing a really bad feedback loop in these other countries. And then you have the energy crisis on top of this, which is preventing these manufacturers from producing profits, from running trade surpluses. So you with these another German firm, I think, soap manufacturer, and a lot of the inputs of the soap are petroleum products and electricity costs.
Mm-hmm.
So,
Jason, I was going to say a lot of this inflation, while we'd love to think of it as being just driven by the money supply, most of it was basically supply chain destruction that's been driving the inflation in oil and consumer goods and everything else.
Well, a combination. So you have all this extra currency, many trillions, and it wasn't just created by the Federal Reserve Bank. It was created by all these central banks and governments. Yep. So they trillions of extra currency units, and then you have less supply, especially of energy. And as we've said previously, the global economy cannot run without cheap energy and cheap electricity. Once energy and electricity costs start going 3x, 5x, 10x up in price, look, these are the problems you're getting now. You're seeing manufacturers, like I said, in Germany, soap manufacturers declare bankruptcy or insolvency. I just saw a new current event story about Chinese steel manufacturers are all very close to going bankrupt. You're hearing mining companies talk about like, well, our profit margins are being destroyed if metals prices keep falling. We can't raise capital. We're either going to shut down mines, and then there's going to be supply problems. So you keep hearing deflationists and people short commodities just ad nauseum repeat demand destruction. Well, Lee, we might be in an environment, and I think the odds are increasing almost daily if this continues with higher energy costs for energy, electricity, and then also falling metals prices with commodities futures contracts. We might be in an environment very, very soon, a high probability, where we have a combination of, for some commodities, maybe demand destruction, but also supply destruction. Mm-hmm. And if you have both at the same time, especially if supply destruction is increasing faster, you have cash and you want to buy things because there's still inflation in the real world that the consumer price index is not accounting for, but the goods are not available because supply is being destroyed too.
Let's talk a little bit about the Fed. But before we do that, I think we need to just lay the backdrop with what I would call almost a bond apocalypse right now. You look at the gilt. Vanguard has an ETF for gilt, and it reached a peak back in March of 2020 at around 27. It traded all the way down to 15 in September. Now it's floating around 16. But to me, that's saying like interest rates, they're going up. Where do you think the Fed's going to be? I mean, do you think they're going to continue to increase interest rates?
In the short term, yes, but the more they do that, the more they break. And actually, there's not buyers of US Treasuries. So we've even gotten tweets out recently from Joseph Wang and the New York Fed. Now, I don't believe everything Joseph Wang says. His track record on a lot of his predictions the last 6, 8, 9 months, very, very dicey. But he actually admitted, and he showed with charts and graphs, he showed that the Fed is bleeding red. The Fed is paying out enormous sums of interest payments because of the high rates, and there is a lack of demand, a lack of buyers for U.S. Treasuries. So there's a lack of buyers for all bonds, basically. That's why I said bond apocalypse, and that's forcing interest rates higher. And who's going to buy the bonds then? Who's going to fund big government in all these countries?
Exactly. No one wants to take that credit risk, really.
Well, this is the problem. Lynn Alden has spoken about this, and also my friend Dave Skorica, shout out Dave if you're listening to this, he's talked about this as well. What happens, the scenario that you said, bond apocalypse, this actually normally happens in a post-war, post-World War environment. So post-World War I, post-World War II in the 1940s, where you had a lack of demand for government bonds. The governments were all heavily indebted. There was big inflation in the real economy, wage and price controls, other problems, a post-war economy. So the economy was trying to figure out how to restructure itself with government intervention, trying to figure out how to kind of get back to more free markets, more capitalism after the economy was basically entirely shut down with wartime. And a lot of the pandemic lockdowns were actually, and supply chain governments restricting supply chains were actually very similar to a wartime because, they were quote unquote fighting the pandemic.
Yep. So I was going to draw that analogy after what you just said.
Yeah. So we're in a very similar environment to post-World War I, post-World War II, where these governments, they don't want to cut spending. DC, neither political party in DC wants to cut spending, which means they're going to they want to grow government. They want to grow government spending, which means more U.S. Treasuries need to be sold. The problem is there's not buyers. There's not demand for bonds. China and Japan, which were running trade surpluses, they're not buying. Japan's selling. The pension funds, a lot of the large pension funds, if they're going to get margin calls, and we're hearing that they haven't paid them, They haven't paid them yet. I mean, last week, what I was told on the phone call with the hedge fund manager is she was reading off that the pension funds, all these large pension funds that have margin calls, they hadn't paid any of the margin calls yet. I guess they were waiting for the plunge protection team lead to create a stock market rally. So
what happens in these pension funds is there's actually an investment committee that have to approve certain transactions. So if you're getting squeezed on a margin call and you don't have the cash to meet it, you have to go to your investment committee and say, hey, I need to sell such and such assets because I have to meet this margin call. So nothing in the world of pensions happens overnight. It's not a hedge fund where they can move quickly.
That's a very good point. The other large buyer of US Treasury, so besides pension funds, besides foreign countries that are running trade surpluses that recycle their reserves into buying US Treasuries, and those were two of the major buyers of US Treasuries for decades. The other one is the large, besides the Federal Reserve Bank, they're the buyer of last resort, though, are the primary dealer banks. So those are like the large primary dealer banks here in the United States. They buy U.S. Treasuries, but then they resell the U.S. Treasuries in the secondary market. Of course, if you speak to a lot of former bond traders, they tell you that the Fed eventually buys a lot of these bonds back on the down low. But supposedly over the last 6 to 8 weeks, and this has been talked about in the Fed minutes, because I was speaking to Wall Street hedge fund guys about this. They were going through the Fed minutes that the primary dealer banks have told the Federal Reserve Bank, due to balance sheet constraints, they cannot keep increasing their purchases of U.S. Treasuries either. So all the major players that were large net buyers, that were the demand side for U.S. Treasuries, are not there.
Mm-hmm.
So this leads us to the scenario Kuppy wrote. Hedge fund manager Kuppy, Harris Kupperman, has written a couple of blog articles about this in the last month called "The Fed is FUCKT." Fuck. Parts 3 and 4, and he outlines basically that, and this intertwines with the tweets that Joseph Wang, the New York Fed trader, is talking about, where the Fed is cash flow negative. So in the past, the Fed was making enormous profits from their bond portfolio. They were buying with QE as interest rates were going lower. They were buying with newly created currency units. They were buying all these bonds, mortgage-backed securities, and all this interest income. The Fed was making enormous profits off of it. They were remitting tens of billions of dollars per year in profits to the U.S. Treasury. According to Joseph Wang, who showed charts on this last week, all those profits are gone. So the Fed is paying out enormous interest payments. With reverse repo, the banks are parking enormous cash there, the large U.S. banks, and then interest on excess reserves, which is where the banks parked enormous amounts of reserves that the Fed gave them for many years with quantitative easing. They're paying out as the Fed raises interest rates. The Fed has to pay out even more interest payments to reverse repo and to interest on excess reserves. So the Fed is hurting itself even more. And then on top of that, there's a lack of buyers for U.S. Treasury. So we're in a very precarious situation where the U.S. federal government here in the United States wants to keep spending more. Asset prices are falling. If asset prices keep falling, especially real estate, you're going to see the tax receipts over the next 6, 8, 9 months just collapse. You're going to see income tax collapse. You're going to see sales tax collapse. You're going to see capital gains tax on stocks, bonds, real estate collapse. And the last one to collapse will be property taxes. That is a worst case scenario for the Fed because they're expected to plug the hole, the funding gap as the buyer of last resort of U.S. Treasuries, because there is not the demand. The normal buyers of U.S. Treasuries are not there. Unless maybe the Fed and Treasury decide to change the rules for the large banks and primary dealers, and reserve ratios or other types of rules are changed to eliminate those balance sheet constraints, and they figure out how to stuff trillions more in U.S. Treasuries with the large banks.
You know, in that article that Kuppy wrote, one thing that makes the point, I think, in numbers, that the Fed had an $8.7 trillion in liabilities at year end. As a result of every 100 basis point move higher in Fed funds rate, that increases the interest cost by $87 billion. That's not a slight increase. That's a lot of money.
Well, isn't he projecting that interest payments on the national debt over the next 12 months is going to be around $1 trillion if the Fed keeps hiking rates?
Yep. I mean,
that is an inset. So the average person out there, since all the bailouts, people like, oh, it's only $1 trillion now after all these bailouts. But you have to measure that against what are normal averages for the amount of annual tax receipts the federal government takes in. And then when you look at that and the average amount of annual tax receipts the federal government takes in, and a large chunk of that, about 30% of those annual tax receipts the federal government takes in are now relying on capital gains taxes. So that's selling stocks, bonds, real estate at profits. So 2 trillion, it's about 2 trillion, maybe a little over 2 trillion is about the average amount. So even if the federal government raises taxes, all the governments raise taxes, you can not really increase the amount of annual tax receipts you take in by more than a couple hundred billion. So you cannot, the number tends to hit a wall and decline at certain levels. So anything a little over 2 trillion for annual tax receipts the federal government takes in, it tends to hit a wall no matter what they do.
Yeah.
So Lee, that would be almost 50% of annual tax receipts just for interest payments on the national debt. So it would not fund defense. It would not fund social programs, defense spending, anything, just interest payments on the national debt. That is if the Fed keeps hiking rates. So that is why you and me have been saying mathematically, the U.S. federal government cannot afford.
No, their only choice in that situation is to print themselves out or have the Fed lower rates. I mean, there's no other options, right?
Well, maybe for a couple months, but the U.S. federal government mathematically, then they can't afford 5% interest rates for 12 months, 18 months, 2 years. It just is not possible. And so much of that, the total U.S. national debt, over 31 trillion now, it was short term. So it was 2 years or less. And now you have about 50% of the yield curve is already inverted. I sent you a chart before we started recording. So if the Fed keeps hiking rates, inverting, they're going to blow up capital gains taxes. They're going to blow up the real economy, and people are going to get fired. I mean, if people are getting fired, are they going to have income for their income taxes? So
I think the economy is in much, much worse shape than people realize it is. I really do.
And that would create the vicious cycle where even more tax receipts that the Treasury is relying upon, that the states and local governments are relying upon, is not going to be there.
And the flip side of that is there goes even more risk into government bonds, not just U.S. government, but municipal bonds as well.
And historically, in post-World War I, post-World War II, what the governments did when they got into these problems with too much debt from the wars, too much government bonds, the government had to keep spending, didn't want to cut back, they inflated the debt away.
Yeah, which I think is what they're probably going to do.
Well, they're not going to be honest about it. I mean, they're already there. So the official consumer price index, the changing propaganda index, or CPI, is still above 8 right now. But the producer price index, Lee, has been about double the CPI for over 12 months. So I would say the producer price index is more honest with what John Williams of Shadow Stats and the Chapwood Inflation Index are saying. The producer price index was saying what the costs for business owners running businesses, all the input costs were 15, 16%. Versus the CPI,
which is and it's even worse in Europe, where they have just enormous energy bills.
And we're starting to see the bankruptcies now. But I think at some point, and at capitalism, free markets, bankruptcies are part of it. But I think the governments are going to step in. I'm not saying I'm in favor of it, but I think the governments are going to step in with bailouts and subsidies. And I think the small business owner is going to get screwed.
Of course, they always get screwed because our governments are basically run by the large corporations who donate all the money to the politicians and make them do things that they shouldn't do, which is, against the interest of the average person. So, I want to talk just briefly about.
One more point here. Let me just add here.
Okay.
Against the interest of the average person, these banks, these governments, these corporations, the taxpayer in Congress, the U.S. taxpayer in U.S. Congress are not even voting on these currency swap line bailouts to the European Central Bank, the Bank of England, the Swiss National Bank.
They have no control. They have no control over it at all, Jason.
Yeah, these are central bankers deciding that they probably party with at Davos, deciding on the phone, hey, let's just keyboard entry over $9 billion this week to the Swiss National Bank. Well, who cares what they use it for, man? I don't care. I'm going to see him at Davos. We can't miss the orgy. We can't miss the orgy in a couple months.
It's on the way, Joe. I'll be there. a few hours.
No, they don't even have to. They don't even have to. They don't even have to print the money and put it on a cargo plane.
Yeah,
They
that's
don't even
true.
have to.
No,
They don't even
no.
have to do slip
It's
ups
just
like Obama to Iran.
it's a few keystrokes now. I just want to mention that, like, I think this is pretty interesting study in how markets work and somewhat intermarket analysis. September 28th is kind of a critical day. That was the day the dollar peaked, and I think we had done a show like right then. And I'm like, I think the dollar peaked, but gold also hit a bottom then, and that's the exact same day that the Bank of England intervened in the gilt market. So you see, like, everything happens at once, and they're like inverse of each other, like the price of gold versus the spike in the dollar, etc. And actually, when it comes to the performance of gold, it's actually performed pretty well in relation to, the yen, and the euro, etc. It's just the strength of the U.S. dollar has been really keeping the price down. And there are other issues, but so I just wanted to mention that. I thought it was an interesting little side note.
In a bear market, and we've been talking about this, it might be about who loses less, but you still have people looking for positive returns. So that's the risk here, is people are still looking around, that trying to call a bottom on Bitcoin, trying to get long all these and or these other stocks and stuff like that, like Netflix. Netflix had it looks like they played some games with their earnings. They had their revenue is still falling, but they increased subscribers. They got mini short squeeze going on, despite how Disney Plus now has almost as many. It's about equal the amount of paying customers as Netflix, and that amount of competition is going to be bad long term for Netflix. So,
of course, yeah. And their content has really, the content quality has gone down over the years.
Well, but my point, though, was that in this environment, in a bear market, so in a normal bear market, if there was deflation, if central banks were lowering interest rates, US Treasuries would be a good trade. Utility stocks would be a good trade. Maybe some defensive consumer staples would be a good trade. But we have central banks threatening to increase interest rates. Now, at some point, it's going to stop. Mathematically, it can't keep going unless they want to collapse everything and then do a some type of weird system reset. I'm not sure.
Well, it's not like others have not spoken about a reset happening. So, you have to keep an open mind in this environment. Some crazy things can happen when things get extreme like this.
But going all in and betting on a certain type of system reset is dangerous too.
Oh, yeah, absolutely. This is a time of real caution. I mean, looking at the markets today, they're kind of in no man's land right now. They've had a really strong bounce off the bottom, which is typical in a bear market, but they could pull back here very easily. Are they going to crash? Who knows? They could also rip much higher. It's just we're in no man's land, and I would not be entering any new trades at this moment or any new positions. You kind of have to wait and watch the dust settle a little bit.
Well, you brought up gold. I think gold and some other commodities are actually close to bottoming. So even though Biden is trying to play all these games, he announced a new strategic petroleum reserve oil dump. He's trying to get the oil price and gasoline price down as much as possible before the November 2022 congressional elections in a couple weeks here in the United States. So he's trying to manipulate oil prices down even further. Oil stocks are actually not down on that news. So there's a divergence there. And the market knows that this is a temporary manipulation. The market is seeing all these supply side problems. They're seeing that OPEC and OPEC Plus, their production numbers have collapsed. There was a new statistic that just came out yesterday. In the last 24 hours, oil and natural gas exploration capex, capital expenditure, collapsed by 60% in 2022. So that's a combination of national oil companies, private sector. Now you have certain countries with like Norway and natural gas production in the United States, certain OPEC producers that increase the amount of natural gas and liquefied natural gas exports. Natural gas prices are still a lot higher over the last 12, 18 months than they were in early 2022. This is actually, even though the natural gas price in the US has had a very substantial correction, I think it's down like 40% in the last 3 or 4 months, it's still a lot higher than 2 or 3 when it was in 2020. So this is a very healthy natural gas price. It was going parabolic though, Lee, at some point. So it was not sustainable, the natural gas price. It was literally the LNG price in Europe and the US natural gas price. It was right around 10. It had gone parabolic. So it was not sustainable at those levels. It was overdue for a correction. But I think like long term, there is still a big demand increase coming for cheap electricity, natural gas replacing coal. But if natural gas is going to stay cheaper, I mean, a lot of these stocks are not reacting to this yet. The farmers I was speaking to, they were waiting for natural gas prices to come down. So fertilizer, the inputs which make fertilizer are cheaper, and then they were going to reorder fertilizer. So
fertilizer has exploded in price, absolutely exploded, and that's going to put a squeeze on the. They were talking about inflation on food products being like 40% or so year over year. I think if there's a shortage of fertilizer going forward, as there could very well be, that's going to be nothing.
Well, but fertilizer stocks, last week, some of them were down 10% in a day.
Yep.
So there's a divergence there between you have lower natural gas inputs, at least temporarily. You have fertilizer prices higher, and you have fertilizer stocks down, not pricing this in. So we'll see if farmers reorder more fertilizer, but there may be good opportunity there. We may be close to a bottom then if fertilizer prices are going to start going higher and farmers are going to start reordering and replanting. The fertilizer companies, even though their shares are down substantially over the last 3 to 5 months, there may be a good opportunity there. I think a lot of them are still fairly profitable, even though their shares are down and they're still paying out some dividends.
Do you have any suggestions as far as investing in your Patreon? Do you have any videos or anything where you're talking about specific companies?
Not lately on fertilizer companies, but I was thinking about a fertilizer article. I mean, the low-cost producers for fertilizer, you have cheap natural gas. So part of fertilizer then would be, do they have cheap natural gas? Do they have cheap inputs? So do they have cheap natural gas here in the United States? So are they like a Mosaic or a Nutrien? Those are firms. I think there's Intrepid Potash and maybe a couple others here in the United States that have an advantage. They have cheaper natural gas on a relative basis compared to the rest of the world. So their inputs are going to be a lot cheaper than other countries. But you really have to look at that because a lot of fertilizer, there's been fertilizer export bans from a lot of countries. And then if you're a fertilizer producer and you have sky high natural gas prices in Europe or the United Kingdom, you can't make a profit at these prices. So it's country by country. Then you have to look at the input. This is how difficult things are from an investment standpoint. There is not a good fertilizer ETF. There was a small one. It was SOIL soil, but it's not liquid.
Okay.
Yeah, it
thinly traded. Yep.
Well, if it was a larger fertilizer or potash ETF, it sounds like a good idea. It has a good name. It's easy to remember, but it's not liquid though.
My guess is people would probably just trade crude because it's such a liquid market, and they're somewhat related.
Oh, the last thing I wanted to talk about though was the Russell Napier article. So he made some interesting predictions. He thinks there's going to be a major capital expenditure boom on the supply side for commodities over the next 15 or 20 years. It would be nice if we see that. Unfortunately, on the policy side for these governments and the lack of capital available for mining companies and other commodities producers, I don't see it.
In order to have big, significant capex exposure, these companies have to be looking forward to having greater demand for their products, and I just don't see that in this environment. I really don't.
Well,
unless something changes significantly.
You also have to have the banks willing to,
of course,
give out large, like for a potash mine or a copper mine or a base metal mine, it's many billions of dollars in debt loans. So not only do you have to sell shares, equity for a lot of these projects, if it's a small or medium-sized company, if it's not a large company, but you also have to raise billions of dollars in debt for a large-scale mine. And the capital from the banks is just not available. There's a lot of red tape. It's a bureaucratic process. So the commodities prices would have to stay high for a long period of time, and that's just not happening. Especially,
we've been entering a time of increasing reluctance of lenders to give out credit, and for good reason, as we see with the bond market and everything. And I don't see that changing anytime soon.
Well, also, Lee, in the summer 2021 and early 2022, before commodity prices fell, you had a lot of banks that actually were willing to give out loans and capital, but they were contingent on like hedging commodity prices. But now that capital is not available. The other problem is you have a lot of countries where when the commodity prices were high, so like in Chile, Panama, other countries, they started putting very punitive copper royalty taxes and other taxes on the mining companies. And then in other countries, and then a lot of the miners are not going to make the investments then if new taxes are coming on. But the other part for these other countries is a lot of these other countries now, because they're pro ESG, they're going to be anti-mining. So if you're pro ESG, And unfortunately, a lot of these green energy technologies, so solar, wind, you still have to mine a lot of materials. So if you need rare earth,
they're so capital intensive.
well, they're
The
rare earth,
windmills and everything. I mean,
they're
just
rare earth elements intensive. You still need a
oh
lot of
yeah,
metals. You still
absolutely.
need.
That's heavy duty mining. I mean, they require a tremendous amount of steel and fiberglass. I mean, it's a huge undertaking to put one of those things up.
Well, some of these environmentalists, honestly, I think some of them think that electricity just comes out of the socket.
You're right.
And solar and windmills just magically appear like unicorns. And
I heard about some interview that someone was doing on an electric car, and someone asked, "Well, where does the electricity come from?" The person responded, "Oh, out of the building here. We plug it in." Thinking that the building just generates electricity. Yeah, exactly.
Yeah, not the natural gas or not the coal or not the nuclear power. Yeah.
Yeah.
And ask California how well solar has done. So
Texas California, too. My God, they had such a run-in with wind power and everything. Remember when they had the freeze over and they were pretty much having blackouts everywhere? It was a disaster.
And that's another key component is a lot of people's electricity bills here in the United States. Those are starting to really spike now. A lot of other countries have had, especially Europe and Asia, have had large electricity bill increases for the last 12, 18 months. Finally, they're starting to come here in the United States because of the much higher natural gas prices.
Yeah, one last thing I want to mention about nitrogen. I don't know if you've been seeing what's been going over the Netherlands, but the government's been cracking down on nitrogen use as fertilizer, and the farmers have been protesting. I mean, the political risk in the arena of food supply is just, I think it's growing.
I did not see that, but nothing surprises me at this point.
It's all part of this green agenda. So,
well, it's creating more distortions. It's causing a global food and energy crisis, higher costs, and the global economy really cannot run, especially manufacturing, cannot run without cheap energy and cheap electricity.
One other thing that Napier mentioned in his article, and I texted you about this before, he basically said the world had gotten used to markets working in like free markets. And he's basically stating that governments are going to get more and more involved in the banking system and the flow of money. I guess he forgot all about the GSEs and how they really basically ran the housing and education. I mean, they pumped so much liquidity into those spaces. And that's part of the reason why we had such a boom in home prices. So this is not new. I mean, it's not like a new trend that he's predicting. It's been going on for some time.
Let's just wrap up here with like a summary of, I mean, there's my buddy Aaron, This Week in Charts, probably the best efficient video at showing market wrap-ups and what's going on global macro and different charts over each week. The major point, I discussed this with Aaron before he recorded the video, this past weekend's video, was that there's very little stocks that are doing well right now. So they're playing defense. A lot of people are in cash. If you hold cash for long periods of time, 12, 18, 24 months, governments are devaluing it. So is your cash fully safe for a short period of time? US dollars, probably safe. 12 months, 18, 24 months, longer than that, it's going to be devalued. So there are very few safe plays right now. Energy, especially oil pipeline companies, the natural gas companies have gotten hammered, but I think there's good opportunities there because at this natural gas price here in the United States, a lot of the natural gas companies were actually hedged at a lower price, and their hedges are rolling off over the next 6, 12, 18 months, and they're going to be hedging their natural gas production at this higher natural gas price than it was 2 or 3 years ago. So the market is not pricing that in yet. So I think long-term, we still have a natural gas bull market, but we've had a really nasty correction. And I think over the next 3, 6, 8, 12 months, there will be good buying opportunities for natural gas and liquefied natural gas companies. The safer ones would be like an EQT, largest natural gas producer, pure play in the United States, or Cheniere Energy, which is the largest liquefied natural gas exporter in the United States. They have long-term contracts with a lot of large companies out to export liquefied natural gas at big profits.
So you're still thinking commodities, gold, silver, longer term?
Well, they had nasty corrections already,
Yep.
and I'm just reading the sentiment for commodities. I'm just even with the comments from the CEO of Rio Tinto, he's talking about the commodities bull market is over, demand for commodities is collapsing. What they're not talking about is all the supply that's going to come offline, the lack of capital that is available. These are all actually good things that will put in a bottom for commodities in the not too distant future, especially if Fed does reverse and announces, I don't know if it's after a couple more rate hikes. So I don't know if they do the 75 basis point rate hike at the next meeting and then say that's it, or we're going to slow down the rate hike increases. And then that means then they're not going to do anymore. But from what I'm hearing from people who actually drink with people in higher ups in the DC Federal Reserve Bank, one of my sources is that QT is over soon. I don't know what you have these central banks doing, Lee, is you've had the Bank of England come out recently and say they're going to raise interest rates. It doesn't make any sense, but they're saying they're going to do it. They're saying they're going to buy bonds and raise interest rates at the same time.
They're probably trying to manipulate the yield curve. That would be my guess.
Or they're going to beg Daddy Fed for more currency swap lines, US dollars, and hope that most people don't find out the real number, and then they're going to use those dollars to buy their own government bonds.
Yeah, I have one comment to make on silver, and this is something I said for a long time. The market could certainly trade down to where it is now, but I said, like, good luck getting silver at that price, and that's kind of proven true because it's almost impossible to get silver 1 ounce coins right now. The supply is tightened so much for these dealers.
So, what are the premiums if you can get silver coins?
Oh, I haven't even looked, but I'm
Is it over
sure
$4?
Elevated. I'm sorry.
Is it over $4 an ounce?
I can check quickly, but I have not.
Well, we're at silver prices at $18.77 here in the U.S. And yeah, you're not going to get silver anywhere near that spot price. I mean, if silver goes another dollar, if with the cost rising for silver miners and base metal miners, their profit margins are collapsing. Capital's not available for a lot of these miners. Silver goes another $1, $2, $3 an ounce lower. I mean, a lot of these silver miners are going to be running, and base metal miners are going to be running cash flow negative.
So I'm looking at a major, well-known bullion dealer right now. Canadian maple leafs are going for $27.51 right now at lowest price. That's a quantity of 100 coins at a clip.
So that's over $8 an ounce premiums.
Yeah, which is crazy. So
the miners are not capturing that premium. So the miners capital is not available. The miners are either break even or running at losses. It is a mess out there.
This is purely a supply issue on the silver bullion. It's just not out there.
So back to, I said this earlier, much earlier in the show, that we may have total chaos. So total chaos would be paper commodities futures contracts continuing to go down, and then miners either taking supply offline or going bankrupt. So that would be a combination then of demand destruction for certain commodities and supply destruction, where the supply destruction is occurring faster than the demand destruction. And then if you have cash and want to buy something, it's not available. So that would be potentially total chaos.
It's certainly unfolding total chaos, Jason. So you want to wrap it up here?
Yep. We really need these fiat currencies to go away, but unfortunately, it's getting worse before it gets better. More government rules changes. There's going to have to be. Look, mathematically, and Kuppy and others have laid this out. There's not the buyers for the US Treasuries. So the Fed can keep hiking rates to fight inflation or maintain credibility all it wants. The dollar is a wrecking ball, Lee. So if the dollar keeps rising, there's going to be more margin calls. There's going to be more bankruptcies for hedge funds.
There's going to be more strain on world governments as well.
Well, yeah, these leveraged bond trades that these pension funds, hedge funds, family offices are going to blow up. And then the banks are the counterparties. So the banks are the ones who gave out the loans to these hedge funds, these family offices, these pension funds. The banks are the ones, and they're going to have to write off the loans.
Yeah, and more Fed bailouts.
Or, well, it'll be one central bank, like the European Central Bank or the Bank of England or the Swiss National Bank, but most likely they'll be begging Daddy Fed for more currency swap lines.
Yeah, most likely.
Okay, well, this was episode number 11 for Finance Unspun. It is a mess out there. Be careful, play it safe. do not try to pick the exact bottom. It is a falling knife out there. There are good companies still available, quality companies. So like your Franco-Nevadas, your Chevrons. I think Cameco is still, the uranium producer, is still a quality company. They did a share dilution though. And in this bear market environment where you do a share dilution, any bad news, and share dilution is bad news even in a bull market, but in a bear market where shorts want to jump on anything, any negative news, the hedge fund, high frequency trading algorithms want to punish any bad news. So a share dilution in this type of environment will send the stock absolutely spiraling down. But if the company has cash, they raise cash, they can go. So they're a low cost producer like Franco-Nevada. They can go, or Chevron, some of these low cost oil and natural gas companies, they can go out and do deals in this environment. In the short term, the shares might go down 2, 3, 4, 5 years. The deal might make the company enormous sums of money. Now, people who are short-term focused don't want to hear this. They're going to complain, say like, why are my shares down? Why are my shares down? Why are my shares down? Well, the company did a smart acquisition, and we're going to look back a couple of years from now. We're going to see that things worked out really, really well. But like, in the short term, they're not going to see the benefits of this.
No, definitely not.
The people who are running these companies, if you're running Franco-Nevada, you've been through bear markets before. You've been through bear markets in gold prices, in silver prices, base metals. You know that you've deployed enormous amounts of capital, billions of dollars during the bear market in 2008, 2009, the bear market in 2015, 2016, and your company made enormous profit margins and free cash flow later on when the cycle turns. So this is how these companies are run. They're run, smarter companies are thinking counter-cyclical, that when the bear market is over.
Well, I think that wraps it up today, Jason. Appreciate your time. It's always an interesting discussion with you.
Yeah, and there's no shortage of crazy news stories going on. I mean, it's just...
Yeah, we could probably talk for another 2 hours easily.
Well, it's going to be interesting to see who they announce actually buys these government bonds, because it doesn't seem like there's a lot of demand at this point and actual buyers.
No, there's definitely a shortage of buyers on all bonds, not just government bonds.
Oh, the junk bonds are getting, the more the Fed hikes rates, the more junk bonds get killed. Yeah, and investment grade corporate debt, if these companies' cash flows drop, the investment grade is going to get downgraded.
Mm-hmm.